Welcome to fxsignal team. Today, we are discussing top 10 Forex money management tips. As always, to succeed at trading you will need a complete trading plan. A complete trading plan will tell you when to enter, when to exit, which currency pair to trade, how to manage your money. So money management is vitally important. Let's start our video. Number 1. Quantify your risk capital. Many of the important aspects of money management proceed from this key value. For example, the size of your overall risk capital will be a factor determining the upper limit of your position size. You might consider it prudent to risk no more than 2% of your overall risk capital in any one trade. Number 2. Avoid trading too aggressively. Trading too aggressively is perhaps the biggest mistake new traders make. If a small sequence of losses would be enough to eradicate most of your risk capital, it suggests each trade has too much risk. A way to aim for the correct level of risk is to adjust your position size to reflect the volatility of the pair you are trading. But remember that a more volatile currency demands a smaller position than a less volatile pair. Number 3. Be realistic. One of the reasons that new traders are overly aggressive is because their expectations are not realistic. They think that aggressive trading will help them make a return on their investment more quickly. However, the best traders make steady returns. Setting realistic goals and maintaining a conservative approach is the right way to start trading. Number 4. Admit when you are wrong. The golden rule of trading is to run your profits and cut your losses. It's essential to exit quickly when there's clear evidence that you have made a bad trade. It's a natural human tendency to try and turn a bad situation around, but it's a mistake in FX trading. Number 5. Prepare for the worst. We cannot know the future of a market, but we have plenty of evidence of the past. Therefore, it's important to look at the history of the currency pair you are trading. Think about what action you would need to take to protect yourself if a bad scenario were to happen again. Do not underestimate the chances of price shocks occurring. You should have a plan for such a scenario. Number 6. Envisage exit points before entering a position. Think about what levels you are aiming for on the upside and what loss is sensible to withstand on the downside. Doing so will help you to maintain your discipline in the heat of the trade. Number 7. Use some form of stop. Stops help to cut losses and are especially useful when you are not able to monitor the market. At the very least, you should use a mental stop if you don't want to use an actual order in the market. Number 8. Do not trade on tilt. At some point, you may suffer a bad loss or burn through a substantial portion of your risk capital. There is a temptation after a big loss to try and get your investment back with the next trade. But here's a problem. Increasing your risk when your risk capital has been stressed is the worst time to do it. Number 9. Respect and understand leverage. Leverage offers the opportunity to magnify profits made from the risk capital you have available, but it also increases the potential for risk. It's a useful tool, but it is very important to understand the size of your overall exposure. Number 10. Think long term. It stands to reason that the success or failure of a trading system will be determined by its performance in the long term, so be wary of apportioning too much importance to the success or failure of your current trade.